All right. Happy Saturday, happy weekend, happy webinar Saturday. Hello. How's everybody doing? Hope you're all doing well. Lucy says hello. She'll be joining us for the webinar, of course. How's everybody doing this evening? Hope you're all having a good weekend. I'm gonna let a few minutes just play out just so some people could join. But while people are joining, give you guys just some heads up for the next coming days in the trading, in the stock world. So we have July 4th coming up is Tuesday. So just so you guys know, the stock market on Monday is going to close at, the stock market on Monday is going to close at 1 o'clock on Eastern time, right? Whereas the market on Tuesday is not going to be open at all. So what I would suggest, I'm probably not going to take any trades Monday because a lot of times when we have a holiday right after, like you see how we're like the weekend, Saturday, Sunday, no trading. Monday comes along for a half a day and then we have another day off. A lot of institutions, you got to think they also probably won't be moving much of the market this Monday because we don't have much follow through. Sound light? Hey, you guys let me know, is that any better? Testing. Could you guys hear me all right? Let me know. Hello. Good morning. All right, that should be okay. Yes, awesome. Okay, cool beans. I'm gonna let another minute or so roll through. So this week's webinar is going to be on price action and chart patterns. And this is a really important webinar because you could really use what you're going to learn here, whether you trade options or futures, whatever you trade. If you're looking at a chart, you could implement what I'm about to teach you into any type of market, into any type of situation, into any time frame. It's all just price action, and price patterns. Oh man, Cliff, that bot got you there. Alright, so let's get into it, guys, right? So it's 6:02, we'll break into it. And so for our first section, we are going to go over candlestick patterns. So how I want to start this is, what is a candlestick? I want to explain, just like we're starting off, just like we're all new, right? So candlesticks are visual representations of price movement on a chart. Whether we use multiple candlesticks, one candlestick, I apologize guys, I don't know what's going on there. But right, so we look at charts as traders and we see multiple candlesticks. Now, if you're a new trader and you don't know much of what's going on, that might just look like a whole lot of hoopla to you. Whereas once you get that experience and you learn what a candlestick is, different types of patterns to look out for, what's really in a candlestick, it could really help you trade better because now you're no longer looking at a mess. You're looking at, it's almost like art. It's almost like reading a second language, guys. It's really great. So each candlestick has four main components. We have the open, the low, this in order is open, the high, the low, and the close. So that's going to be different if you're looking at a green candle, that's a bullish candle, or a red candle, which is a bearish candle. If you're looking at a green candle, your open is going to be on the bottom of the body. Now this is the body, and the upper parts are called wicks. So the open will be at the bottom of the body and the close will be at the top of the body. Whereas on a bearish candle, the open will be at the top of the body and the close will be the bottom. Because it was red, we went down in price. Here we went up in price, but the highs will always stay the same and the lows will always stay the same. The low wick, the highs, the highs. That's the candlestick. That's where price reached in this candlestick, the highs and the lows. Alright, so let's break into exactly what kind of candlesticks we should be looking for. So this is the hammer and the shooting star pattern. The hammer pattern is a bullish reversal pattern characterized by a small body and a long lower wick. So you see how this is a hammer candle because we have a very small body but a very enormous wick. This is a lot of buying pressure. Like I say on the streams very often, guys, if we're seeing a lot of lower wicks, that's a lot of buying pressure coming into the market. We might see a reversal. It suggests that buyers are stepping in after a downtrend, potentially indicating an upcoming reversal, right? So this is really powerful if we were just selling off strong, and then what we would do is we would catch retail traders in this wick before we reverse. And by catching them, they have to then place their stops somewhere up here. And once price is reversing, they're going to have to buy their orders back. And by them buying their orders, they're going to add fuel to the fire to make this move go higher. And vice versa. If we're looking at the shooting star pattern, this is a bearish counterpart, which is a small body and a long upper wick, or an upper shadow. Some people call it shadow, some people call it wicks. They're mainly called wicks in the stock world, just so you guys know. But this one suggests a lot of selling pressure, right? So you have to see wicks as if at some point this candlestick, this body, the body was all the way up here, and it looked like it was great. It looked like buyers were in control, but then sellers came in, stepped in, and crushed it all the way back. And now sellers applied that selling pressure and are showing that they mean business, that they're coming back to take control. So don't get the candlestick I just showed you mixed up, the hammer and the shooting star, with the doji, the gravestone and morning star. Now I know some of these sound a little similar, so I don't want you guys to get confused. If you want, you could always come back to this webinar. Are you presenting the patterns in a particular order, ones that use the most? No, so there's no particular order in these. I figured I would just start with what a candlestick is and then work my way through. And then eventually we do have chart patterns like the head and shoulders and things like that, but that's a little further down. I wanted to go over what candlesticks to look for. That way we could learn the candlesticks and implement them into the chart patterns. And that's what's really great with this. So the doji is a candlestick pattern, and it is characterized by the candle with a small body and nearly equal open and close. Now when I say a doji, when I'm trading with you guys, when we're on the live stream, when I say a doji, I usually mean a small body or nearly no body. Now this is almost no body, right? So there's no body on this because we opened at the same price as we closed. Let's say hypothetically this was 4,400 on ES. We opened at 4,400, came down to 4,490, went up to 4,405, but then we closed at 4,400. So the open and the close is an equal price. There's an imbalance. Buyers and sellers are not sure who's in control yet. There's no sure thing in a doji candle. It's almost like, let's see. It represents market indecision. That's the word I was looking for. It's indecision candles, guys, right? So buyers aren't in control, sellers aren't in control. We stick out of this type of trade, stay away from this type of candle until price shows otherwise, until price does want to reverse from that candle, or until it continues. And again, these candlesticks are just the start. We're going to get into some chart patterns, and then you could use these candlesticks within those chart patterns to get even more high probability trades. So the doji, the gravestone doji pattern has a long upper shadow and a small or non-existent body and no lower shadow, right? So if we're looking at a gravestone, we would look for a long upper wick, and you got to think of it like a grave, like the buyers are in the grave, right? So we just closed it, right? All these buyers just got swept up. There's the gravestone. Now here's the morning star. You got to think morning star, stars go shooting. In the morning, the sun comes up. We're morning star, we're coming up. So what that means is buyers came in and we're getting buying pressure on this candle. So that would be the morning star pattern, and that's a bullish reversal pattern that consists of 3 candles. Oh, nope, that's the next one, actually. That's actually going to be on this page, that morning star. I do apologize about that. I think I got the evening star. Yeah, so you see... Yeah, I got the evening star and morning star mixed up. Sorry about that, guys. So the evening star is what this one would be. No, sorry. That is the morning star. But this description is not right. Don't want you guys to write that down. Don't write down the morning star description. That's the description for this evening's. Wait, yeah, the evening star. Again, guys, I do apologize. I was making this today. Been dealing with a bit of a headache this week. But let's get back into it. I usually don't make mistakes on these, so I do apologize, y'all. Doji does not necessarily mean reversal. Right, so doji doesn't necessarily mean reversal in a sense of it sort of means just indecision, right? So we don't know if buyers are going to win, if sellers are going to win. And buyers don't know if buyers are going to win or sellers are going to win because it's an indecision. We have to wait for price to create an impulse move to prove bullish or bearish. So the engulfing candlestick is a reversal pattern that typically occurs at the end of a trend. And what you're going to look for on an engulfing candlestick, right? So here's a bearish engulfing, is we want price to cover the highs and the lows, and we want it to completely engulf it, right? Think of it like it's engulfing it, it's eating the whole candle, it absorbs the whole thing, and it usually means for a reversal down. Whereas a bullish engulfing, right? So here's our bearish candle. Oh no, do you guys still hear me? OBS disconnected? Should be okay. Yes, okay, good. It scared me. I got a notification, OBS disconnected. Very good. I'm sorry. Awesome. So the engulfing, right, is a reversal pattern. A lot of patterns we look for, guys, in the stock market with these chart patterns and candlestick patterns, you're going to notice a lot of them are for reversals. And those are the types of trades we want to get in because once we get in a reversal trade, we know where our stop will be. It's normally going to be if we're getting in a bullish engulfing, we'll enter somewhere here and put our stop loss at the lows. And if we're getting in a bearish engulfing, we would wait for it to close, so it's an engulfing, short it on the next candle, and put our stop at the highs. So that's how we would use those types of candlesticks and those types of price action. And again, this is just some notes on it, where the second candle completely engulfs the body of the previous candle, as you guys know. Now moving on, the morning star and evening star. This pattern is a phenomenal pattern that I use very often. Now this is something I'll look for, something on the smaller time frame, because what I'll look for sometimes is I'll tell you guys this would be a supply zone, right? So this is a green basing with a long wick followed by a red sell-off, but this is actually an evening star pattern. So let's go over the evening star. The morning star pattern is a bullish reversal pattern that consists of 3 candles, a long bearish candle, a small bodied candle, and a long bullish candle, right? So this would be the morning star. We had the bearish, we had a small body with a long wick showing we're rejecting, and then we had a big bullish candle. So how you would enter this trade is you would wait for the candle to close, enter on this candle, and place your stop at the lows, and you would be able to then either do a measured move or find your next key level or supply and demand to target from there. And the evening star pattern is the bearish counterpart, whereas this one is down, consolidates, and goes up. This one goes up, consolidates, and goes down. Tweezer tops and bottoms. This is another good one. Tweezer tops and bottoms are a little harder to find because they sort of have to be very close. So the tweezer pattern occurs when 2 or more candlesticks have matching highs, so that would be for tweezer tops, or lows, which would be for tweezer bottoms. So for this one would be a tweezer top. In general, what time frame are you looking to enter trades? So in general, for me personally, I'm looking to enter trades on the 5 and the 15 minute, but I do my charting on the 1 hour, 2 hour, 3 hour, 4 hour, and larger. But we'll go over charting and whatnot another time, or maybe even later. We'll see. So the tweezer tops and tweezer bottoms, right? So we're looking for equal highs on tweezer tops to see how we based around here. But again, it's difficult to find an exact spot because a lot of times there's a bit of a spread between bid and ask. There will oftentimes be a bit of a break just to grab liquidity because the market knows there are people with buy orders at the highs or their stop losses at the highs. So the market might want to stop hunt and then continue. But these are the types of tweezer tops or tweezer bottoms that would indicate a reversal. So the tweezer top suggests potential resistance. Think of it like if we had a key level right here, guys. The tweezer top would be perfect to play a rejection off a key level of resistance. Whereas a tweezer bottom would be a great trade to take long off of some area of support. Is there a way to predict the next candle will be? No, so that's the whole thing. There's no way to predict what candle will close like what. That's a great question, because obviously we would love to right? Let's say this candle's forming, we get a big candle up, we get a doji just like this, and we're anticipating a drop like this. If we got in right here, anticipating it move lower, but we didn't let the candlestick play out and we didn't let price play out, this price could end up going higher, and then it won't even make this pattern for us. And once we do our trade review on that, what are we going to say? I got in too early, I anticipated, I wasn't patient, and these are things we want to stay away from. So that's why if you're waiting on the 5-minute time frame for these types of candlestick confirmations, wait on the 5, but watch the 15 for the trend. So wait on the 5 for this type of confirmation and hold on the 15-minute time frame. If you want to look for this confirmation on the 1 minute, 2 minute, 3 minute, then look at the 5 minute for trend, and so on and so on. I know tweezer tops and tweezer bottoms are a lot easier, and you'll see a lot more of these produce and come around near key levels, resistance. You'll also see a lot of these on smaller time frames, because a lot of times a larger time frame doesn't stay that close in a range. It'll usually either give us a trend or a much larger range to trade. Alright, so the next section is going to be chart patterns, and I know this is a little bit of a quick webinar, just going over some of the basics. If you guys want, what we will do afterwards is I'll pull up Thinkorswim and we'll go into an empty ES chart, and we'll try to find some of these patterns on a naked chart and see how they play out. Gotta remember, these chart patterns don't hit 100%. A lot of them are notorious for even winning in a losing percentage, 40%, 50%, 30% win accuracy. But that's where it comes into play. We have to have our key levels, our supply and demand, because once we start having our chart patterns with key levels and supports and resistances, then we really see high probability trades play out. Alright guys, don't forget, hit that like button, I do appreciate it. So we're going to go over the head and shoulders pattern first, and I want you guys to know the head and shoulders, this is the same as an inverse head and shoulders. You would just flip the chart. So the shoulders, there will always be two shoulders on a head and shoulders pattern, usually lining up around the same price. If they're not around the same price, sometimes you might have the shoulder up higher a little bit. They'll always be under the head. The head has to be the top price. Think of it, if we're looking at a head and shoulders, our head is above our shoulders, I'd hope. But that's how it should be. So the head forms after the left shoulder, obviously, and that typically reaches a higher price level than both the left and the right. Now the neckline is important too, because the neckline could give you a really solid entry if you didn't enter on the right shoulder. So the neckline is a horizontal or sloping line that connects the lows of the retracements between the shoulders and the head within the head and shoulders pattern. It acts as a level of support, often serving as a reference point for traders to gauge the pattern's validity. Guys, I'm so sorry. Again, it's been a bit of a long week, so I do apologize, but I wanted to make sure I got a webinar together for you guys, because I like doing these weekly webinars. I feel like you guys enjoy it, and it's something I do want to continue doing going forward. So as long as everybody keeps participating, I appreciate you guys staying patient with me. We'll keep them going. And so let's see, this was how we would draw this neckline. We would draw it off the wicks of the lows, right? Wick of the low. This was support, 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 support. That's 4 touches of support. Now, the more touches for support and resistance, the better. If you only have 2 touches on a support line, you do not want to draw that. You need 3 touches on a support or a resistance trend line or price level to confirm it and to validate it. So 1, 2, 3, 4. What happened? We broke down. We had a big pullback, and we reclaimed that level. This is a chart, guys. I got this right off of the ES. This is off the ES 5-minute. So if we were waiting for this, we would have really been able to get a nice entry on that, right? So let's move on to the rising wedge and a falling wedge. Again, guys, so this would be the rising wedge where we fall and sell off. And if we were looking at an inverse chart, it would be a falling wedge. A rising wedge is a bearish continuation pattern, and it is formed by converging trend lines, with the bottom line being steeper than the top trend line, right? So this is a lot lower and it has more of an angle, whereas the top trend line isn't straight, but it's not as angled as the bottom one. And again, this type of chart pattern would signify a price move lower. You see how wide we are right here? And then we start to get closer, and these trend lines get closer and closer, and price starts getting tighter and tighter. We would look for a short position with price getting tighter and putting our stop at the highs, and we would take it lower. Or, just like I always tell everybody, wait for it to break, retest, right? We had this green wick to retest, and we could have entered once this started failing, put our stop at the highs of this wick, and we would have been able to let this trade really play out. That would have been a fantastic trade. A falling wedge, again, guys, that's just the inverse of this. That's the bullish continuation pattern. So if we flip this chart, we would see price was falling, 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 getting tighter, and then it would pop, almost like a short squeeze. So next we have an ascending and descending triangle, and I spelled triangle wrong. I'm not surprised. I bet you there's just like a white box over it. I know how to spell triangle, I promise. An ascending triangle is a bullish continuation pattern, and it is formed by a horizontal resistance level and a rising trend line, right? So we have the horizontal level right at the top, so this would almost be like a key level, and then we have the trend line right here. And just like we saw on the rising and falling wedge, with price getting tighter and tighter before we get the move, price is wide and it gets tighter and tighter until we get our move. Here we have our entry would be on the break, right? We would get either on the break or near one of the bottoms of one of the lows in case you're anticipating the break, and you could enter here, put your stop loss at the recent low, and then you'd enter and take your profit. You see how it measures this move right here? And it gives you a measured move to take profit, so that's a great thing. A descending triangle is a bearish continuation pattern, and it is formed by a horizontal support level and a declining trend line. So again, it's just the opposite, but we get tighter and tighter until we finally break and usually have a very fast sell-off. I see a Head and Shoulders on Google daily. Nice. So we'll take a look into that. We'll take a look. If you guys want, think of some charts, think of some trade ideas, think of some times you saw some type of chart pattern. And remember, don't tell me yet, but maybe later what we'll do is we'll go into some charting and we'll see the types of Head and Shoulders and we'll see it play out. Is a wedge or triangle pattern more predictive than the other? In other words, one better? Not really. Yes and no. I wouldn't even say yes and no, really. What did we say? The triangle and the wedge? Yeah, so personally, I feel like I see a lot more rising wedges and falling wedges, and I feel like I see them a lot more on the higher time frames, the 4-hour, the daily, the 2-hour, and a lot of times with those time frames, when you're looking at those time frames, you have to try to trade those time frames. So if I'm looking at this type of pattern on the 2-hour, and every one of these candles is a 2-hour chart, I'm not going to zoom into the 5-minute and try to scalp the 5-minute on the way down, because then what's going to happen is it's going to chop a bit on the 5. We have this green pullback, right? So there are plenty of areas we could have got faken out if we went to the smaller time frame. So a great clue, guys, a great hint that I wish I could tell myself back when I started was whatever time frame you're charting on, whatever time frame you see a pattern on, trade that time frame. Trust me. Trade that time frame. No matter how big it is, no matter how little it is. If it's little on the 1 minute, then you trade the 1 minute and you scalp it. If it's large on the daily, then you trade the daily and you swing trade it. But regardless, whatever time frame you're watching and you're getting that pattern in, trade that time frame. Alright, so we went over this. Bull and a bear flag, guys. So a bull flag is a continuation pattern that occurs after a strong upward price movement, flag pull, and I'll show you guys exactly why they call it that. And it's characterized by a consolidation period in the form of a flag pattern. And again, I'm going to show you guys exactly what I mean. And it indicates a potential continuation of the previous uptrend once the consolidation is resolved, right? So take a look at this big candle right here, right? So they're considering this to be a flagpole. It just shoots right up. Big, strong, big, strong flagpole right here. Then what do we have? We have our little flag waving, falling back. And while we're consolidating here, people are thinking we're going to pull back all the way. But the problem is we're consolidating. We're not pulling back. We're consolidating. We're accumulating. We're failing to go lower. And we would take these clues to know, okay, we're in a bull flag. Let me grab some long contracts. Let me grab some calls over here. And then you'd be able to get in for the next leg. That's what a bull flag and a bear flag does, guys, is it separates the first leg or flagpole from the second leg or flagpole. A bear flag is a continuation pattern that occurs on a strong downward price movement. So again, if we inverse this chart, that's what we would be looking at. Let's see. How do you make a measured move in ascending, descending wedge? So you would do the same as you would, so you see how ascending and descending triangle is the top, is this first range right here. You would do the same thing, so right here you would measure this range, this up and down, and then you would measure it from there to there, and you would plot it from there to there, and this move, I think it even went lower than the measured move. But again, guys, if you could get to that measured move or lower, that's how you could place a great trade. That's how you know where your risk is, where your reward is, and that's really something great that you could make work out in your favor, guys. Speaking of work out in your favor, I have a risk reward video I was working on this morning, and I had some issues getting the subtitles going, but I got that together, so that should be out this evening. Alright, so we did bull flag, we did bear flag, ascending triangle, descending triangle, so a pennant, right? So a pennant, again, we're looking at another triangle pattern. Let me tell you guys, the stock market loves its price action, and it loves its triangles. Let me tell you why. It doesn't love triangles because it loves shapes. It loves the triangles because it shows price getting tighter. See, we have this big range of this first candle. Then we come up, then we come down, but we're not coming down to previous lows. We're creating a higher low here. We're creating a lower high here. And then we come up a bit, and we come up a bit, but we're failing. We're getting tighter. Price, again, is getting tighter. So what we look for on these types of situations, guys, is we look to be patient. We look to be patient enough that we could draw out one of these trend lines before the break happens. And if we could draw it out before the break happens, it gives us the ability to gauge our entries, to gauge the market, and it gives us an edge in the market. And that's what you need to trade successfully. You need a good edge. So a pennant is a short-term continuation pattern that resembles a triangle. Again, guys, almost all these patterns are triangles. It is formed by converging trend lines, creating a small symmetric triangle pattern. It indicates a brief pause or consolidation in the trend before the price resumes its previous movements. So again, guys, it's just we had the drop. We had, instead of a flag, we had a pennant, right? So think of it this way, too. If we were retail traders, we would think maybe we're reversing here. Meanwhile, we know we've been selling off. I always tell everybody whenever we're live trading, we're selling off, right? The trend is our friend. The sell-off is way stronger than this pullback, so I'm going to look for another sell-off to enter. So now that I missed this sell-off and I missed this sell-off, I'm able to plot this pattern, this pennant, and I'm able to then enter once I see one of the candles I like. So now we could go back to the price action candles, right? And we could say, okay, well, look, it looks like a shooting star or a hammer. Now let's go back and take a look. It looks like we almost have a hammer right here, right? With the top wick and the body. So it looks like this could reverse, right? And go lower. So we could enter here and put our stop at the highs and let this trade play out. Again, you would measure this move from the top of this range to the bottom of this range, and you'd be able to grab your profits sort of right down over here. I don't have a measuring tool on here because this is just the Google Slides, but that would have worked out pretty well for you. And again, trend is your friend. If we can't figure out what direction we're in, then you need to look left. You need to zoom out. You need to look at higher time frames. Those are things you need to do to become successful when you're not thinking straight. Pennants typically occur after a sharp price movement and signal a potential continuation of the trend once the consolidation is resolved. Again, that's almost exactly like the bull and bear flag, how the uptrend would continue once the consolidation is resolved as well. We have to remember, guys, this consolidation, it's not there just to fake us out. It's there to grab liquidity. The stock market needs to grab liquidity before it gives us another move lower. And the reason for that is that liquidity, you got to think of the stock market as a car, right? Cars need gas. Liquidity is the gas the market needs to move. So without grabbing any liquidity, don't expect any movement. Sometimes we get big news, and the news will move it before any type of consolidation. Well, that news is the fuel that moved the market. So now let's move on to double tops and triple tops. Right here, I only have on the screen is a double top. Obviously, you guys know triple tops would just be if there was one more equal high in the middle. Triple tops are stronger than double tops, just something to remember. So double tops are reversal patterns that occur after an uptrend, and they are characterized by two peaks that reach a similar price level, separated by a temporary pullback or retracement, right? So we came down, we came back up, came down, came up, came back to the same price level. Now, guys, I don't want you guys to get confused because a lot of times we'll see some type of double top or double bottom, but it'll throw us off because the second top might have gone a little higher than the previous one. Don't let that scare you. If we're still rejecting that same area of interest, as I call it, it's still a strong area. So when I'm teaching you guys these types of price actions and these types of candlestick and chart patterns, I want you to use this along with the support and resistance and supply and demand that I teach, and you're going to have a full trading book all by yourself, all on your own. That's it. There's no reason to overcomplicate it, guys. You can use as many indicators as you want, as many moving averages, anything. And you know what? If it works for you, it works for you. Moving averages are a great thing. I know a lot of institution traders even trade with the 8 and the 20, right, for trend. Because when you're trading with an 8 moving average, an EMA, an exponential moving average, and a 20 EMA, the 20 is going to be a lot further back from the 8. So once those cross, almost like a MACD, it gives you a buy signal or a sell signal. And that could help if you're having trouble reading price action or you're having trouble dictating direction. Moving averages could really help you. And they could be almost like training wheels to help you get a gauge of direction, but don't get too mesmerized with them. Gotta learn the price action itself, the candlestick patterns, all of that, guys. It's good stuff. You know, up here, guys, on this double top, this would almost be a tweezer top, right? And we were talking about that as a candlestick pattern. So now we have a double top and a tweezer top right here. That's two confirmations of this chart pattern on this chart. Would have taken it short once we started getting weak again up here, stop at highs. And this wouldn't be much of a measured move. This would be just a great trade that you could get in near the top. And getting in near the top on one of these trades, guys, is huge. Then you're able to get in. You can maybe get in with a little extra size because you know your stop loss is so close. And you could let the trade run and maybe cut one or two off as the trade goes in your direction. But look at the sell-off that we get after that, right? Just like this sell-off, we got another strong sell-off. Triple tops are also reversal patterns that occur after an uptrend. They consist of 3 peaks that reach a similar price level with 2 retracements in between. So again, it would go up once, pull back, up twice, pull back, and then it would go up one more time and then completely sell off. Alright, and again, guys, double tops, triple tops, this is the same thing if we were looking at a double bottom or a triple bottom. It's just being inverse the chart, and that's what you find. Alright, so that wraps it up for our slideshow portion. And again, guys, I did mention earlier, we'll go into Thinkorswim and really go over exactly the price charts and the chart patterns and give you some real-time examples, because that's what really brings the quality to these chart patterns, is being able to see it on a real chart. Alright, guys, don't forget, hit that like button and subscribe if you haven't already. We do these webinars every Saturday. I do apologize about the issues on the other couple slides before. It's been a bit of a hectic week, but we're all humans, so I'm not too upset about it. I hope you guys aren't either. I promise it'll be better next time. I do have a lot of content in the works too. I have a risk reward video coming out momentarily. I'll probably finish that up once I'm done here with you guys, and I'll probably get some other videos up for you guys too. Alright, so let us pull up Thinkorswim. And awesome, good. I'm glad you guys enjoyed it. Again, I do apologize about those few slides that were sort of off. But so let's see, guys, right? So let's look. Here's a tweezer top example, but it's not exact. So again, guys, tweezer tops are hard because to find an exact area where we wicked off exactly each time is very difficult. But what you could see here is that price closed right here, it opened right here, it closed right here, it opened right here. This is a strong spot right here, so we could see this as a form of a tweezer top. We could grab it short once we see all these rejections. We wouldn't want to grab it short down here. We would want to grab it short on one of the wicks. Remember, put our entries where other people are putting their stops. So we would be able to grab a short on one of these wicks and scalp the next candle. Now this is a 2-hour time frame. Let's mark it down to the 5-minute, right? And let's get the 5-minute on the 30-day. And let's just start over, right? Let's start fresh. Go back over here. Let's see if we see anything. And if you guys see anything, let me know. Let me know in the comments. Say, hey, wait, what's that? Hey, wait, look at this. Let me know. So let's see. We'll let you slide. Cliff, thank you for letting me slide. I appreciate it. Let's see. I did have, remember guys, I will tell you, in the slideshow, every chart you see is ES. This is ES, this is ES, this is ES. Whenever I do one of these presentations for you guys, I make sure to go into ES and find you guys real-time examples. I don't want to Google it and find an example of it, other than I think it was this one, the ascending and descending triangle I couldn't find on ES. But bull flag, this was a real bull flag on ES. Rising wedge, this was a real rising wedge on ES. Head and shoulders, look how perfect this head and shoulders was to a T with this neckline. And this was a real setup on ES. This would have been a trade you guys could have taken. So let's get back into that. See if we could find those. Alright, so here's a bit of a double top, and we had a sell-off, but if we were looking at the 5-minute, again guys, we would have to trade on the 5-minute. We see we topped off over here, we came back up, retail's chasing it higher, we know that this is an area of resistance, so we go short up here. But listen, when we're going short up here, it's not as easy as that. When we're going short up there, we have to remember, before we go short, the chart looks just like this. And to think that we're going short on a candle that's so strong, please ignore that we're in an inverse chart right now. But to short right here at an area so strong, you got to think retail's chasing this. Retail sees this big candle with a little wick, and they know that means strength and we're going higher. But we know this is an area of interest. Maybe this was a key level we were watching. And again, if this was a key level that we're watching, that adds that extra boost of confirmation. So you would take it short there, stop at the highs, and you would scalp it on the 5-minute, right? So you would get a nice big move and maybe target the bottom, right? So you see how we wicked out over here? So you would target near the bottom. Oh, wow, Cliff, your pun slide just went right over my head. You said, well, let it slide. I was like, oh, that's nice. I didn't realize Google slides. But, Alright, so let's see what else we got, right? So, let's see. Mark this out. And we'll see if we can maybe get a wedge. But we're not getting much of a wedge here because what happened was we got a breakout. And again, guys, just because we break out doesn't mean we're going in that direction all the time. Sometimes we could be faking out. What is it you overlay support and demand on the chart? How far back in time do you go to determine support and resistance levels? I go back as far as possible. I'm not talking 20 years, but I might go back a year or 2 or 3. I don't really see it as how far back I go. I see it as what time frame do I go on, right? So here we had this this rising wedge. We had this bull move. We have a pennant, and then we have a move higher. Let's see if we find anything else. Sort of hoping we come across that head and shoulders that I made. And if you guys want, you could check out, I have a support and resistance webinar up. If you guys check out our webinar playlist, there will be 5 webinars in there now. So definitely some good stuff. All right, so let's see, right? So here would be a trend line. We could draw a trend line from here to here. And what we could do is we could edit properties. We're going to make it a bit thicker. Again, this is a white chart, so we have to be a bit careful with that. And we're going to extend it to the right. And we're going to see how that trend line plays out. Because remember, trend lines could also work as a support and resistance. We're supporting it, supporting it, supporting it. Now let's see if when we break it, if we come back and retest it. Now see, we're not really coming back to it. Oh, look at that. Came to it for a moment and we held it. So this is head and shoulders. See, guys, I wouldn't really mark this as a head and shoulders, although we did technically sort of get a bit of a left shoulder, a head, and then a right shoulder, and it did play out. Let's see, where would our neckline be, right? So our neckline would go up somewhere like this. Yeah, see, even the neckline is a bit messy, guys. So I wouldn't be a fan of this one. You want, when we're looking for chart patterns or price action patterns, we want it to be as clean as possible. We want the market to prove to us that it's clean. No more us proving to the market that we know what we're doing or we could trade. No, the market has to prove to us that's the price action it's making. That's the support it's making. That's the resistance it's making. And once it proves these things, we could take more confident trades. All right, so here comes that trend line. And you see how we did hold it. We broke it, then it was resistance. I don't want to stay too in touch with that trend line, right? Don't stay too attached to it because that was just an example. I do want to find us some real-life chart examples of chart patterns. I believe, let's see. Let's hit the 15-minute, right? See if we can find anything better. Because the higher the time frames, the smoother the chart. Because if the gotta remember, if the 5 minutes choppy, the 15 minutes gonna be a bit cleaner, and vice versa. Damn, I must have deleted. All right, so here's the pennant right here, right? So we had an uptrend. Oh, no, that's the one I just marked. Yeah, I guess I deleted. Oh, unless I have it. Yeah, there we go. I might have it on here. Or not. Oh, yep, here we go. Here we go, guys. So here's that head and shoulders pattern. This was on the 15-minute, so the 5-minute was where I took that screenshot. But we had the left shoulder, bit of a pullback, or right shoulder, the head, pullback, and then the right shoulder. So we would have been able to enter puts or shorts here with our stop at the highs, and we would have been able to take this lower. Or if we missed our first entry, we could wait for the pullback, because there will be a pullback to the neckline if it's a clean head and shoulders, and we could wait to enter here. Now, if you were to wait to enter there, guys, that would really pay off. And the reason for that is if you're trading options and you wait for the right entry, it could really, really go in your favor. You could get great big percent returns, great return on investments, really good stuff. So here is that rising wedge, and we ended up selling off. So let's see if we did get that measured move. We'll go from here to here. Again, change the color on that. Now let's activate it and see if we got that, right? So look at that. We got even more than that measured move on that drop. So that would have been another great trade. And that's another great example of how these chart patterns work out, guys. But listen, we would have been able to take profit, and then look, we reversed, right? So we got to remember, if trend is our friend, we have to stay with the trend. But we could go with the price patterns as long as we have a valid stop and a valid entry and a valid reason to enter. We can't just get in just because we see a rising wedge. How do you develop the discipline to wait for a setup? So you really, to develop the discipline, it's really all psychological, right? It's all psychological. It's all breaking it down into what are we looking at on a chart. If you're waiting, again, if you're looking at the 5-minute charts, you're going to want to enter on the 5-minute. If you're looking at the 15-minute chart, you're going to want to enter on the 15-minute. Now, some traders might say, well, if you're looking at the 15, try to enter on the 5. If you look at the 5, try to enter on the 1. In my opinion, that gets a little too confusing. I would much rather enter on the 5 or the 15, but then look at higher time frames to find confirmation, to find entry points, to find my support, resistance, supply, demand, head and shoulders, knees and toes, all of it. I look for the higher time frame to confirm it. Lowest I'll go for a chart pattern is 15 minutes. Because you got to think also the 5 minutes, guys. If the 5-minute and lower is notorious for faking us out, for taking our money, then try to stay away from it as much as you can. As long as you keep a higher time frames chart lined up with you, it helps keep you disciplined. Because if I'm looking at, let's say, let's throw ES on here too. Oh, this is going to be a bit of a tough one to set up. Let me just make sure. For show. Load style. For show. Where is it? Load style. Alright, well, it doesn't want to load style for me. So that's fun. Let me see if I could save this style one more time. And we're going to load that into here if it wants to show up. There it is. All right, so if I'm looking at the 5-minute, right, I want to make sure I have a 15-minute up. If I'm looking at the 15-minute, I want a 30 or a 45 or an hour up. The hour time frame, guys, I know somebody that trades, and he uses mainly the hour time frame to enter and exit trades, and he'll literally wait for that 1 hour time frame to close. He'll wait for it to close above demand. He'll wait for it to close below supply. He'll wait for that because he knows once you're patient on the hourly, it really pays. Gotta remember, just like Jeremy tells us that quote, trading is taking the money from the hands of the impatient and putting it into the hands of the patient. So remember, the higher time frame you look, the bigger the move you're going to get. The lower the time frame you look, the quicker you have to be. Simple as that. If you're getting in the lower time frame, you should want to scalp. So like right here, let's see if we could find that on here. No, wait. So these are both on the 15th, so I would bring this one to 30 or the 1 hour. 1 hour does bring us back a lot. Oh, there it is. Right, so look, if we're looking on the 1 hour and we're looking at this head and shoulders, right? So this head and shoulders worked out great. We got our entry on the smaller time frame, and now we're able to hold on the hour. And that's a great entry. You're able to swing trade, not swing trade, but you're able to day trade this versus scalping it. When you're scalping it, I'm talking about the 1 minute time frame, 5 minute even. If you're holding for more than 5, 10, 15 minutes, you could consider that a day trade. But when I think of day trades, I think of more holding it for an hour or two or even longer. So again, we found this head and shoulders on the 15 minute. We got in, we held, and we got a nice sell-off. We got paid for holding for that sell-off, right? It's 26 points. It's a good move. Next, we had this rising wedge, right? And again, this would have looked nice on the hourly. We could have entered on either of these hourly candles with a stop at the highs, and we could have targeted the lows, or the low of the rising wedge where it started. So if I went like this to try to get the exact move, again, look at that. Would have been great. Would have been a great measured move right there. But if you look at this right here, and this is where supply and demand come in, guys. We, on the hourly, created a demand zone right here. We created a 1 hour demand. And I won't make this video about supply and demand. I know I've already made too many videos about that. But to be able to then say, I have my supply and demand here, I have my support and resistance, and now I'm staying patient and looking for these time frames. I'm looking for these price patterns on these time frames. Well, now I'm putting all the pieces together. How long do you usually stay in your trades? John, that really depends on the market context that we're in. So if we're in a tight range, if we're in a small, like 10-point range, I'm maybe in for a minute or two. I want to scalp that. I want to be in at the top of the range. I want to sell at the top. I want to buy at the bottom. And that's how I would play a range, right? We'd be scalping it. I wouldn't buy anywhere in between, because once we're in a range, if we have highs, if we have lows, we know where to sell. We know where to buy. We know where not to touch. If we touch anything in the middle, then we have to hold ourselves accountable once we get in and it goes against us because we were impatient and we didn't get in at the highs or the lows. So, again, we came up, we had this rising wedge. We realized on the hourly that we could target the 1 hour demand, and we would have been able to take this short and targeted for 180.25, and we would have got a great move out of that. Instead of using the measured move that we measured out that ended up getting us out of the trade about 5 points early, we could have then used demand as a target, and we could have even used demand as an area to enter the next trade, right? Knowing that retail is chasing this falling wedge, rising wedge, and we know there's a demand here that's going to hold up. And why is the demand holding up? Because we're creating now a higher low. We created a higher low, another higher low, and we're going higher after we sold off. This sell-off wasn't a sell-off, but a liquidity grab. And what did we do? We had a great impulse move. So a lot of times, guys, we find these patterns, and if you're even more patient, depending on the zones and depending on the time frame, you could find an even better trade. Let's see if we find anything else on here. So again, would this be considered a double top? Not so much. It does go a little higher, which doesn't disqualify it, but it's not that clean, right? So let's see. Although could maybe see this and this as a double top, because look how close these are. And remember, guys, if we're trading ES and we look at NQ as well, we could see if maybe ES made a lower high and see if NQ made a higher low, because that'll show us divergence, and on top of us having a double top, we have divergence pushing us in that direction too. Again, we're looking for multiple confirmations to give us higher probability trades, because when we trade, we don't want to be gambling. We want to be taking high probability setups with high probability trades, and we want to be smart about it. How do you develop? Alright, any other questions, guys? I'm going to keep going through the charts a little bit longer just to see if we could find any other examples, but I think we're going to probably wrap up this webinar in just a few minutes. Again, guys, if you don't mind hitting that like button, I really do appreciate it. I like to go out of my way to make these webinars for you guys. I like to try to make them special, try to make sure you guys could learn something from each time, whether I'm doing support and resistance, supply and demand, chart patterns, options. I'm just here to help you guys learn, and I'm glad you guys show up, so I do appreciate y'all. So let's see. So here we go. This could almost be a triple top, but don't be fooled by the wick. So this is something we would see on the higher time frame, not so much the lower time frame. The lower time frame, you could try to convince yourself that it's a head and shoulders if you put your shoulder all the way over here and your head up here. But again, me personally, I wouldn't like that because I want the market to prove that it's a clean head and shoulders. It's a clean pennant. It's a clean chart pattern. Because when it's clean, it's mean. You gotta think of that. When it's clean, it's mean and it works. It works best when it's clean. If it's not clean, you have to ask yourself, well, why isn't it clean? Then when you ask yourself, why isn't it clean, you gotta ask yourself, am I forcing this chart pattern to work? And that's when you really start to realize, okay, yeah, maybe I'm forcing it because I feel the need to be in a trade. So let's see, again, guys, triple top, right? We bodied right here, again right here, again right here, triple top, and we had a sell-off. I believe it was a... It has so you could see it as a head and shoulders if you want to count the wick, or if you look at the 15-minute and you want to spread it far. But I would want the head and shoulders to be the right shoulder here, the head here, and then the left shoulder here. We could maybe count this as the left shoulder and know that it's a much lower shoulder. But again, this isn't a clean chart pattern to me. All this tells me is I'm just circling the swing highs, and I don't like that. That's not head and shoulders in my opinion. But that's just me, right? So maybe it might work out for you. So it all depends. Trading is all just trial and error and really taking your time and doing it right. Risk reward is huge. How do you decide if you should scalp, swing, or day trade based on the pattern? Victoria, that's a great question. So I decide that based off of the higher time frame. So if I'm finding the pattern on a higher time frame, I'll swing trade it on that higher time frame. So if I see the pattern on the daily, I'll swing trade it looking to hold it for a few candles, which means a few days. If I'm looking at it on the 2 hour, then I'll look to day trade it 2 hours, 4 hours, 6 hours, 8 hours. And again, once we start hitting over a certain amount of hours, it turns into a swing trade, because unless you're trading futures, the equities market is only open from 9:30 to 4. So you cannot trade after 4. Sometimes options with SPY and QQQ, you can exit trades till 4:15. It's not always the case, so don't bet on it. Don't rely on it. Let's see. Let's see if we got anything else, guys. We got a triple bottom right here, right? So we have bottom 1, bottom 2, bottom 3. And what that's telling us is there's a wall of buyers right here, and the buyers are holding us up. So unless the sellers really prove themselves, which they're not, buyers are going to come in and take over. And again, you have to remember, at this point in the day, at this point in the trade, the market doesn't look like this. It doesn't look obvious that it's going to reverse from the triple top. It looks like this, which if you're a retail trader's perspective, you're seeing this and you're saying this is bearish, we're going to keep going. But that's why we have to stay aware of chart patterns and things like this, because we had 1 bottom, 2 bottoms, 3 bottoms that we kept failing to go lower. We could enter any long position around here, stop at the lows, and we could target the highs right here, 44.12, right? Enter here, have a 12-point target and about a 5-point stop. Over a 2-to-1 risk reward, that's a great risk reward you would want to take on that trade. Here's an example of us failing the swing high, guys, right? So here is a higher low, then we have a higher high, then we have a lower high, another lower high, and now we failed again, creating another lower high based off of this. So again, this would have been bulls. People were chased this long, not knowing that price action in the chart patterns and just pivots alone were suggesting that we would fail this level. And once we get to this level and show weakness, we could then enter this trade, hold, and wait for it to play out in our direction with our stop at the swing highs. So again, this would have been a great trade to move your stop on, or to be able to target back to this area of consolidation. What's really great, guys, with trading is it always leaves clues behind. No matter if you look 2 years back, 2 weeks back, 2 hours back, sometimes not 2 hours back, but it always leaves some clues behind, right? So if I'm looking for this range right here and right there, and I make that, just want to make it like something that we could see. Now, right, this is our range. We broke the range from the triple bottom. We broke the range. We went higher. Now, if we wanted to short it up here because we saw the swing high, now we saw we're making a lower high and got short, we would be able to target back to this area of consolidation. That's just like how I find my supply and demand zones, guys. It's all areas of liquidity that have to work as an imbalance. They work as a magnet, and price really, really goes to them. So again, we ended up going lower, and what we could have seen here, right, is we bounced at this first area, but we failed to go higher. We came back in, we bounced again, but again, we're failing to go higher. Just like when we fail to go higher in a demand zone, it suggests and tells me this zone is getting weak. It's going to break it soon. So what happens? We fail again, we fail another lower high, another lower high, could have entered shorts here, stop at the highs, and look, it grabbed one little quick liquidity grab to grab these highs, but we should have had a stop over here. That's the real swing highs. And again, if we're looking at a higher time frame, we're looking at right here, right? So we grabbed that liquidity on that awkward wick, came back lower, still again failed to go higher, and then we just completely sold off from there, right? We broke structure, we came lower. So that would have been a nice trade too. Let's see. Could consider this potentially a double bottom. I'm not that big of a fan of it. Again, guys, seeing double tops and double bottoms and head and shoulders, all of these chart patterns, they're great, but they could mean next to nothing if you don't have other styles and other strategies with them. Now, whether you have just support and resistance, which is what I call my key levels, right? So a support becomes resistance once it's broken, resistance becomes support once it's broken, or you have supply and demand, and we're triple topping at a supply zone, or we'll double bottom at a demand zone. That double bottom is the confirmation to get long in demand. And we talk about confirmation quite often, and I get a lot of questions about supply and demand and confirmations on supply and demand. And I use these chart patterns, whether it's a chart pattern or a candlestick pattern, for those confirmations at supply and demand. So that's what I look for when I'm trading. So let's see, right? So we go higher, higher, pants on fire, and now we're about right here. Yeah, we had some nice bullish action lately, guys. Been a very bullish market. I just want to say one last thing before I sign off. And guys, if you got any last minute questions, please don't forget to hit that like button and drop that question in the chat. What I like to, what was I gonna say? Oh, I had something on my mind, and then I lost it. I'm gonna see if I can find it again. Oh, yes, I remember what I wanted to say. So a lot of people have been asking me, like, oh, well, is it harder for you to swing trade calls or swing trade longs because we're in a bear market, or, you know, we're in a bear market, are you sure you want to go long here, you want to hold longs? But I keep reminding everybody is that we're not in a bear market. If we look at year-to-date SPY, if we look at year-to-date NQ, year-to-date almost any stock in those, any top 10 stock, we're in a bull trend right now, right? So the market opened right here, right, year-to-date. This is the first day of the year, and we're all the way up here. So we're up on the ES from this year's lows. Oh, it doesn't want to tell me there. Oh, no. Let's see. All right, here we go. We're up 680 points. We're up almost 20% on ES year-to-date, guys. Up 20%. That is not a bearish market, guys. Gotta remember, when in doubt, zoom out. I know last year there was a lot going on. There was war talks. There was this. There was that. The whole Biden thing. The whole everybody's split. Everybody's not getting along. None of that matters. The stock market doesn't care. The market's going to react however the market wants to react, regardless of what's going on. And we have to be the ones to react to the market's reaction. You get what I'm saying? We don't move the market. The news sometimes moves the market, but sometimes it moves a little funny. A lot. Thank you, by the way. A lot of times, what happens is we'll get news of somebody having layoffs. I'll never forget Meta, Amazon, and I believe Microsoft all had really big layoffs, and it was around Christmas time. I'm talking big layoffs. I'm talking 10,000 people each, big layoffs. Everybody's, I think Tesla, not Microsoft, Tesla, Amazon, and one other, maybe Meta. Meta, I know it was definitely Meta because they layoff season all the time for Meta. But they had the layoffs, and instead of the market dumping their stock, the market ended up rallying their stock. I mean, look, year to date on Meta right here. Let's just pull up nothing on this chart, right? Meta year to date, oh my goodness, is it's gonna be crazy, guys. It's 170 points, 144% return on Meta if you just bought Meta stock at the beginning of the year. 144%. Not options, not futures, not this, not that. Just the stock alone, 144%. And you're going to tell me we're in a bear market on Meta? I don't think so. What else? Microsoft. Again, another great example, guys. We started the year here. Now we hit highs up here. Where is that? I don't know. I have to move my chart around because Thinkorswim likes to make me look silly. Meta up 40, Microsoft up 46%. That's a big percent because Microsoft was a big stock, guys. We opened on Microsoft's around $240, whereas something like Meta, we opened year to date, we opened pretty low, around 120s. Yeah, right. And remember, before that, we were even in the 80s, 90s. Oh my goodness, guys, the comeback that Meta had from the lows. 220%. 220%. Oh my god. I'll never forget. I was at a party while we were in this bearish phase and everything. And one of the guys there knew that I traded, and Amazon was down here, Meta was down here, everything was low, Google was low. And he knew I traded, and he was like, "Yo, what should I invest in?" And I was just like, "Bro, if you get anything, get Meta." Why did I say that? Because Meta, from its all-time highs, had a way rapid drop, a way stronger drop than any of the other stocks, right? So it had a ways to go. Whereas if we look at something like Microsoft is at new highs. Apple is at new highs. These stocks are at all-time highs. Meta has room to go still. It still has this gap to fill up to right here, right? Up to 323. Meta has a gap to fill. So it's all things to take into consideration. We've been in a very strong market. Overall sentiment on the market has been bullish. Why fight the trend? Buy the dip. All right. Any last questions before I wrap this up, guys? Again, I do appreciate you all tuning in to this week's webinar. It went a bit longer than I expected, actually. Again, I do apologize about those few slides, but I do think everything went well. If you guys want me to go back to the slides just so you guys could grab some extra screenshots, but don't forget also, guys, the webinars are recorded, so you could go back to them if you want to go back. If the chart is in an accumulation phase, is there a pattern to determine which direction it will break range? Victoria, that's a fantastic question too. So if we're consolidating, you have to look at what direction we're coming from. So if you see how we're consolidating on Meta, the direction we're coming from is bullish. So that leads me to think the direction we're going to go out of this accumulation is going to remain bullish. And that's just because I'm following the trend. With just basic price action, basic following the trend, I'm going to stay bullish. But until Meta proves me otherwise, right? We could look at this and say, well, actually, this looks like it's topping out up here, right? This looks like a bunch of tweezer tops because we keep failing, we keep hitting up here, and we keep failing. Okay, sure. So we could take a short up here with a stop loss at right here and have a really, really close stop, a really great risk reward on this trade. But just because we have a risk to reward doesn't mean we're in the right trade. It just means we have a good risk to reward, which is a great thing, but you have to add that to being in the right direction, to being in the right chart, to being in the right stock, and so on and so on. So let's see, right? So again, you could short right here with the potential of us pulling back over here. You know, if we really wanted, it almost looks like meta, guys. Here we go. Here's a little call out on the webinar. Left shoulder, head. Now I'm going to be waiting for this right shoulder around here. So if we get that right shoulder, and I would want it to hold this area right here. So that's what I'm looking at. I want it to hold this 265 area for this right shoulder. And if that plays out, we could see a big move lower, and that would be a swing trade. We're looking at the daily time frame, so we would want to get an option that expires within 2, maybe 3 weeks, because we don't know how long this is going to play out. But we also wouldn't get in up here anticipating left shoulder, head, and right shoulder, because if the right shoulder doesn't play out, we're just going to go up from here, and it's only going to hurt us. I see Lenny. I don't know if you're still watching right now, Lenny, but you came in a little late. Don't worry. I'm going to send the link will be in our Discord, so you could click there and you could watch it from there as well. We see swing higher than implied move for the 3 consecutive weeks. Does that mean market may come down? Talking of price action, we see swinging higher than implied move for the last 3 consecutive weeks. What time frame are you watching? Let's go ES. And let's pull up the daily and the weekly, right? So let's look at the weekly on here. The daily on here. Weekly. Yeah, so the weekly, what I was looking at on the weekly and what I was actually looking on NQ as well, is we have on the weekly, especially for NQ, we had a rally, then we had a basing last week, just like we had a basing on ES, and then we had another rally. So personally, I could see this trend continue, right? But something I'm going to look out for is this weekly supply zone right here. This weekly supply zone might be an area where we might get a pullback, right? This is a weekly zone. Weekly zones are a lot stronger. This is the implied move, including option. I'm not too sure what you mean by that. Like the implied move. Like the measured move? I know Sig was going over measured moves. Guys, I want you guys to run that like button up to at least 16, 17 before I get off. I'd say 20, but then I'm just needy. Alright, but let's sit back ES on that, right? So again, guys, if we're looking at these higher time frames, I'm saying bullish on these. Just gotta. Higher time frames are telling me we're going higher. Gotta stay with the trend. Alright, ladies and gents, I think I'm going to wrap it up there. It is 7:15. Good, so we did run about an hour and 15 minutes. That's great. Again, we did go over those slides earlier. Once the webinar does end, you'll be able to go back and rewatch that. All right, I hope you guys all have a fantastic day, a great weekend. Don't forget the market is closed on Tuesday, and the market closes at 1 p.m. on Monday, so 3 hours earlier. So there's probably going to be low volume and low volatility on Monday, so be careful trading, guys. You don't want to be caught up in some chop. You also got to think institutional traders are probably taking a nice 4-day weekend, so why not treat ourselves too? All right, with that being said, guys, hit that like button. Have a great weekend and happy 4th of July. Take care and happy trading.